Welcome to the daily update, where I'll go over the action in the market for Wednesday, August 21st, and then we'll see how things look for Thursday, August 22nd. Had another update. There's some pretty positive vibes in the market right now. Unfortunately, we're seeing volume continue to drop off, and that is always a concern. I've been trying to point that out. But the market is positive, but possibly a little too positive. In the short and intermediate term, our list is getting longer of extreme positive readings. And we're even a little bit overbought or extreme positive in the long term. But as I always say, that can also suggest good momentum. I do have a thing called the SPXInvesting Program. It's currently free. There's a link below this video that will take you to the website or to a playlist that will share more about the program with you. You can email me if you have a question about that. If you do end up joining the program, even at the free stage here, you get immediate access to the daily videos where they're not available until the market closes. And over the weekend, you'll get immediate access to the weekly videos where those are delayed until Sunday evening. So feel free to check that out. Okay, also, the daily video is the real foundation of the analysis that I do. All of the other videos are weekly videos, and they're meant to tie into the daily video. Let's go back and talk about what happened. We did have a higher open, not a gap higher or anything like that, but we did inch higher going into the open. And we briefly went above R1 at 56.17, and then we declined below the daily pivot. We're still dealing with that 5,600 level at 56.01. And then we actually dropped down to the unchanged level, which was a little bit below the daily pivot. That ended up providing support. We climbed back up to R1, and then we just kind of chopped around mostly below R1. But then right going into the close, we were able to close at R1. We were up 0.42% on well below average volume. And we are positive in the short, intermediate, and long term, but looking overextended. There wasn't really any new information that came out from the meeting minutes from the last Fed meeting. So we're just kind of going with the current scenario. Now, there's something else that I'll talk about here in just a moment that the market could have freaked out about and actually justified why we could switch over to a more negative scenario looking at the economy going forward. But I'll deal with that in just a moment. Interest rates continue to fall, and that gives support to stocks. And inflation seems to be under control, at least for right now. We're not really getting any economic reports this week that help us to clarify that situation. Of course, lots of geopolitical concerns going on at this time. Okay, small caps actually had a pretty good day. Unfortunately, they just bounced up to where they were before. And the meeting minutes, when they came out, said that a rate cut was plausible at the meeting, suggesting a September cut was all but guaranteed. So the market's been figuring 100% probability of that actually happening. It's just, what is the context of that rate cut going to be? Right now, the market's taking it as positive to help stimulate the economy since inflation is coming down. If we start to get economic reports between now and the middle of September, it could switch back over to a more negative scenario. Here's our short-term list, and it's pretty long right now. We're back looking extreme positive with the advanced decline ratio based on 19 periods. The slope oscillator is actually starting to get extreme, and this is our touchiest oscillator, so it tends to move quickest. The 20-period exponential moving average of the S&P 500, the rate of change going back 10 periods, and then here's our other usual indicators that are, anytime we're moving up or down, these are always on the list. The Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics, the boom indicator. This is not always on the list, but it has been for a few days. And then when we look at our stocks inside of the S&P, we're getting a little extreme with the 20-period moving average study. Also getting kind of a long list here in the intermediate term with the balance of power, the CMB composite, which has been there for a few days now. We're back up looking extreme with the McClellan oscillator for the S&P. The Swenlin trading oscillator based on volume is back to looking extreme. It never really came down all that much. The PMO studies, which were on, off, well, they're back on the list now. The Sean Trend Meter, the bullish percent index for the NASDAQ 100, and the ultimate oscillator. And in the long term, we still are looking extreme on the chart that I show of the rate of change going back 200 periods. And then we're getting a little extreme with the 150 and 200 period moving average study. And there's really no change now for the scenario that the Fed has been leaving rates unchanged, higher for longer. And right now, we're not seeing this, oh my gosh, the economy is falling off a cliff scenario. It looks like those concerns have been subsiding, and we are pretty much planning for a rate cut in September. The dollar was down and interest rates were down. We continue to fall with that 10-year yield. We're at 3.78% with the 10-year, where we had been at 3.82%, but we're still inverted with those yield curves. Sentiment is neutral. We're still ticking up. We had been at 42. We were able to tick up, still in neutral territory here, but we're crossing above that 50 line, so it's turning even a little more positive. And we are positive with our trend. We are a bit concerned because the ADX is below its moving average. And I'll show you all the charts of these things. But the green line is above the red line, so we are positive. With the up day, our bias is positive, and the last number of days taken together, that's our momentum, and it continues to be positive. We had the weekly MBA Mortgage Applications Index. Now, this is not a market mover. It's just something that I like to look at. It comes out once a week. And it gives us an idea, okay, what is the housing market looking like overall? Well, it was down 10.1%, or last week it was up 16.8%. Now, this is another one, and I actually did a supplemental video that I put on the website. There was a thing called the Non-Farm Payroll Revisions Report. And I did a video, if you want to go check that out. I did the video before this report was released, and it actually came in much weaker than expected. There's some media outlets that are kind of picking up on this, saying, oh my gosh, the government reported that we actually lost jobs when, as the reports were coming out, it said we were gaining jobs. The problem with this is it covers from April 2023 to March 2024. So this is already old information, and is probably why the market didn't really react to it all that much. So it showed that there were 818,000. There were some predictions up to 1 million jobs, fewer than what had been reported, creating some concern that the labor market has been softening for a longer period than previously thought. And this is what freaked out the market with the last employment situation report, that it was weaker than expected. Oh my gosh, the economy's falling off a cliff. We need an emergency rate cut. We're going into a recession. Well, this kind of justifies that, but we're not really seeing that in the reports. Now, this is from March. The next employment report we're going to get is going to be for July or August or whatever it is. I guess it'll be for August, since it'll be coming out in September. But all of these are calculated in a different way. There's the employment situation report, and there's different ways of doing that. There's the ADP jobs. There's the Schiller measurement that we use. There's this one, which is probably the most accurate since it's based on state data. And all of these kind of mush together, but there's so much lag with this particular report. It's like, okay, what's the market going to do about that? Because the market looks forward. It doesn't look backward. Now, there are exceptions to that. Back in about 2004, 2005-ish or so, when they were coming out with GDP, they were doing revisions all along the way, and the market, and we were in a difficult time. Maybe it was 2003, and whenever that was, it was after 9/11, and then everything just tanked, and the dot-com bust was happening, and all these companies were going out of business and everything. Well, they came back, and instead of being in a recession for maybe 3 quarters, we had been in a recession for 5 or 6 quarters, because they revised the GDP numbers, and that did impact the market. And people were really disappointed about that, and actually angry about it, because the market relies on this information. As manipulated as it may be, the market still keys off of these things and reacts to it. So, but there really wasn't much of a reaction here. All right, here is the MBA mortgage applications index where it was up in the previous week. It was down in the latest reading. This is looking at the liquidity index. I did show this not too long ago, a few videos ago, but the red line is going up, and that tends to be more positive for the market. You can see when this is going up here, and this is the S&P 500 index itself, and that tends to add more money for the index to actually go up. When we were really running into some problems, we were seeing liquidity going down. So this could end up being positive for the S&P 500. Also, we look at the truck tonnage index and compare it to the S&P, where they were really coupled with each other and having a tendency to go in the same general direction at the same time, even though they're on different scales. But this has really trailed off and gone sideways as the S&P has been going up. Global market implied, the ERP is what we say here. This is the, let's see, earnings risk premium. Is that right? Where when you look at the US, that's in green, where it's starting to turn back up, but compared to other countries, it's not as much here. So it's calculated by each regional strategy team. All specific assumptions differ between regions. They're all calculated using the same basic framework here. So this just means how much risk are people willing to take to get into stocks, basically. And when this is starting to go back up, they're willing to jump in and take more risk. But with other markets, they're willing to assume more risk, like in Asia and in Europe, as well as the whole world taken together, where there's earnings behind these companies. So in the US, so there's not as much of a risk premium here in these particular investments. Then profits matter more than politics. Well, you can see what happens when we have the Democrats in control from 1928 to 2023. The total returns were positive based on political party. But if you look at the earnings per share growth, it actually did better under the Republicans. So yeah, if you're a Democrat, you're going to pull on this left side here. If you're a Republican, you're going to pull for this side over here. Okay. Then looking at the economic surprise chart, this is coming down a little bit. Now, if this keeps dropping, this could suggest economic weakness. But so far, the market is back to the point where bad news is good news. So if an economic report comes in weaker than expected, that usually supports the market going higher. We switched to that other scenario a few weeks ago where bad news was becoming bad news. Well, now we've switched back to this other scenario. Then looking at largest tech companies significantly outperformed smaller counterparts in the first half of 2024. This is the largest companies here and how they performed, and then how they performed in the second quarter, what they're anticipated to do in the third and fourth quarter, and then the smaller tech companies, how they're expected to do. Then landing ahoy. Now, there's folks that think we're going to have a hard landing. That means we'll go into a recession. There's folks that think we'll have a soft landing. That means that we will not go into a recession. Well, there's a number of people that say there's going to be no landing. And what in the world does that mean? Well, based on what I've been able, the definition that I have is that the Fed keeps raising interest rates, but economic growth still continues and inflation does tick up, but it's not necessarily out of control. It just means that everything keeps growing along with the stock market. Now, we don't know what's going to happen, but there's certainly no shortage of opinions here on what people think will end up happening. But you see the light blue area here? That's what the market is pretty much anticipating right now. And I have another chart to show you later on that we look at pretty regularly here that also suggests the market thinks we're going to have a soft landing, meaning economic slowdown. The Fed is done raising rates possibly, and likely getting to the point of cutting rates to help stimulate the economy without going into a recession. Okay, now this is something that I want to deal with here because based on the chart that I have, this chart is wrong. This is put out by Carson, and I actually made another video. No, I made a post on the website about this. There's a thing called the ZWAG NYSE Breadth Thrust, and we watch that, and I go through it in the weekly video, and then whenever one of these is triggered, and it has a very high success rate. We're still working off of one because once one of these is triggered, it lasts for about a year. And the last one was in October 2023. We got close a few months ago, but we missed it by 1 day. And this just shows you when a ZWAG NYSE breadth thrust is triggered, what are the returns going forward? And you look 6 to 12 months out and we're higher every time. And I know this is real blurry down here. I have to blow up my browser to like 500% just to get this a little bit bigger, since this is almost unread. No, it's actually clearer than usual here. But I want to give you a chance to at least be able to see this a little bit. Now, this is the chart that I look at. Now, there is a day lag with this, but the idea behind a ZWAG NYSE breadth thrust is we come down and we drop below 0.4, and within 10 trading days, we zip up. That's the thrust. We go above this red line. Well, we didn't even come down to 0.4. We did get above this high level here at 0.615, and that's positive in and of itself. Now, there's another day lag here. This was the decline that we saw on Tuesday. And so then we had Wednesday was an update. So this may actually turn and go back up because there is a little bit of a delay here. But according to this, we have not hit the true criteria for this. And there's been some posts on Twitter or X and Isabel Net, the chart that I just showed you, they are saying that yes, there was a ZWAG NYSE breadth thrust, but you can see right here, we did not meet the criteria based on this particular chart. Okay, global debt. Isn't that interesting? We're getting up to 315 trillion. Just for kicks, you have any idea how much money there is in the world? I looked it up, and we're right at about 400 trillion if you take everything together, at least based on what I found, but that could be incorrect too. Depending on how people want to play this game, some people say that we already have more debt than money that even exists. But are we going to get to that point? Even if it is 400 trillion together, we're climbing very quickly here and getting up to that level. What's going to happen at that point? Yeah. Okay. Then this is some cycle work. It was actually posted by Real Investment Advice. I use this kind of loosely. It's interesting to look at this, and sometimes it kind of lines up with what we're seeing here. And that's what it appears to be. It says a surge in global liquidity is brewing, promising a potential economic upswing. Sometimes the cycles aren't really with each other. Sometimes it marks right when the liquidity starts going up, right when we go into a recession. This was the whole great financial crisis. But this seems to be lining up right now. Of course, here's the whole COVID lockdown and everything that happened there. And really, during that whole time, we actually saw liquidity going up. But this cycle is suggesting that it's actually going down with all the mess. And then we got into 2022. So take this for what it's worth. But according to what we're seeing right now, this could end up being positive for the market. All right, then. This is also Real Investment Advice. This is Lance Roberts. It says, how do you know when you're at the latter stages of a bull market? It's when they start creating all these exotic things. And right now it's ETFs because everybody's ETF crazy. I just stick with the SPY myself. But now they have things like covered call 2 times, like leveraged and things like that. And when they start coming up with all these kind of new crazy ways of doing ETFs, that's what he's suggesting, is that we're in the later stages of the bull market. One good sign is when Wall Street is delivering products to meet demand. And it says 50% of all the ETF launches in the past 6 months were sitting in the derivative category, like options, futures, mortgage-backed security. They derive their value from something else. So they're derivatives. And he actually cites this as the covered call and 2 times leveraged single stock issues and all this stuff. So just something to be aware of, just when they start creating all these new crazy things that people want to get into, sometimes that means we're getting a little bit late in the party, but it might end up meaning nothing. This is something posted by Sentiment Trader. They have their own thrust indicator based on the tech sector, and they call it the tech index favorable periods, where what we're seeing right now is this is really going up, and it's up 14 times. It's up 100% of the time, not being down at all. And here are the average and median returns with the maximum return and the number of times that we were over 20% here with really no negative signals going forward. Okay, here's our intraday chart, and I'm still trying to include this nice little rise that we've had here. That's why these charts look a little bit smaller. At some point, I'll break this down and I typically just go back the last 5 trading days on here, but I just want to give a little bit bigger context as the market continues to go up. But we had a higher open. We got almost up to we got above R1, didn't quite get to R2. Then we came back down to the daily pivot and then the unchanged level, which is a built-in support level sometimes. It was that way on Wednesday, and we were able to bounce back up, and then we trailed a little bit above, a little bit below R1, and then closed just a little bit above R1. And the intraday chart, we're pretty much flat with the futures right now for Thursday's session. This is still looking good, but it could look better. The red line is still above the blue line. We would like to see the blue line above the red line, meaning growth is outperforming value intraday. But the fact that they're both going up is positive. And this is another thing. I want to go back to where we had that big decline and then show how on an intraday basis, growth has been improving compared to value. Now, it didn't do all that much even in Wednesday's session, but overall, it has been showing an improvement. So here's our end of day chart where growth was down, but down less than value. And this is incorrect. This is the actually correct chart. I forgot to delete the one from the previous day. Growth was up, but up less than value. The mid cap saw a pretty good day for growth, and the small caps saw a pretty good day for growth. Okay. And then we're showing a little bit of improvement, but not really breaking out yet when we look at small cap growth to value. Mid cap growth to value improving, but not really breaking out yet. Showing a little bit more of improvement with S&P growth to value. We would like to see these doing better than they're doing. Now they're positive, but we want to see them really. I mean, we're within what 1% or so of an all-time high from the S&P. We want to see these really going up and leading the market higher. So even though it's positive, we would like to see this doing better. Discretionary to staples bouncing back up, but not really taking a leadership role right now. And we look at this growth versus value ETF, we're still coming up and showing an improvement, but we're inside the rainbow. Large cap growth is doing pretty good. We were up a little over 1/3%, and we were able to recapture the 50-day moving average a few days back. And this is still looking quite positive. And when we look at the large caps versus small caps had a pretty good day. So we came down a little bit with this ratio. But typically, when the S&P is going up, we want to see this ratio going up as well. Here's our trend. This is the little concern that I'm saying. The ADX continues to decline below the moving average. Not a huge deal, but at some point with the green line on top, we want that green line to keep going up, which would eventually turn the ADX around. And it hasn't done that yet here on the intermediate term chart, but we are positive here. We're trying to roll up a little bit here in the short term, but it hasn't crossed above the moving average yet, but we're also positive in the short term. But volume just continues to drop off here. So sentiment, we saw a really big decline here with the Ulcer Index. It's like it was sleeping at higher levels and said, I better wake up and fall out of bed here. So we're seeing where fear is starting to calm down based on this indicator. And we were up a little bit here with the VIX. And that's another interesting thing is we were up before the open and the VIX was up on an up day. Yeah, I think people are getting a little bit nervous about things. There's still hedging going on even when we go up. We typically see the opposite of that. So the VIX did go up a little bit. We also went up a bit here with the bar chart. And when the VIX goes up, the volatility of the VIX also picks up with the bar chart and the line chart. But the momentum of the VIX continues to be down. And we're pretty much flat with the equity put call ratio daily chart. We're still going down here with the 5-day chart, and we're starting to get down to this area where this is looking extreme, which could be overbought. Remember, we have to read this in reverse here. And to give you more context, this is a longer term look at that same chart. We're getting down into this area. Now, we could still drop below where we're at right now. But when we get down to this area, that's when we want to take notice of this. And this is also suggesting the market is overbought. The 10-day continues to decline. This is a little bit slower. We don't really have the big ranges here like I do on the 5-day chart. Okay, and then looking at the VIX, we continue to fall, but seasonally, as we go throughout the month of August, we typically, and then September, October, we typically see the VIX going up, which could mean there's pressure on stocks. And we want to keep an eye on the spread between risky and not as risky bonds here. This is the chart that we look at, but it's inverted. We tick down a little bit, and we're not really screaming to the downside. This is when we had the big decline. But we would like this to continue to go up. That means fear is decreasing, and it didn't in Wednesday's session. But with this fear gauge, we did decline, and we actually, well, we ticked down just a little bit here with this other fear gauge. And looking at the risk on versus risk off ratio, when this is going up, folks are more risk on, and it was resuming its upward move now as folks are willing to jump more into these high beta stocks. Volatility risk premium getting a very low reading, but starting to turn back up, but we're still well below this band for right now. And looking good here with the advanced decline line based on price. We're breaking out to a new high. We're also looking good here based on volume, but we have not broken out yet. So there's a bit of a negative divergence here. And even with the upward move, we saw a real move up in the new highs. And so that's making our 5-day and 10-day average going up. And we're really not seeing any expansion of significance here with the new lows inside the S&P. So internally, this is still looking rather strong. The advanced decline ratio, 19 periods, it's coming back up above this green line. That's when we consider it to be extreme positive, but the red line continues to go up. So taken together, both of these are positive. And we're starting to get extreme here with the advanced decline ratio based on price. We're a little bit below this line based on volume. And here's our accumulation distribution, still showing that we're maybe a little far away from the moving average based on the boom indicator here. But this is still positive, and we're seeing the red line starting to turn and go up. So this is still looking positive taken as a whole. And this is a smart money indicator because it's based on volume as well as price. And the chicken money flow is now full on positive. We came back and we turned green. The red line's going up. So 2 of our 3 smart money indicators are positive. We tick down just a little bit. We're right at this red level here with the Chaikin oscillator, but since we're above 0, we continue to be positive. So 3 out of 3 of our smart money indicators are positive. We want to keep an eye on this one because this one was starting to go up even when the S&P was still going down. Is this going to start to go down while the S&P is still going up? Just something to be aware of. The vortex is still positive with the green line above the red line. The green line's back to advancing or the red line's slightly declining. That's positive too. This is another primary indicator. And we're breaking out with the cumulative measurement here, the S&P 500 based on price. We're going up, but we haven't broken out yet based on volume. And we're showing an improvement here with the 10-day average of the S&P 500 highs minus the lows. It's coming back up. What would suggest positive momentum on a longer term basis is if we can get back above this green line. And we look at the cumulative NYSE advanced decline line based on price. It is improving. But when we look at the regular NYSE advanced decline line, it's breaking out and looking quite well right now. Here's another slightly calculated in a different way NYSE advanced decline line, also looking quite positive. Then we break it out with the common stock, with the advanced decline line here on the NYSE, breaking out, setting a new high here, and also breaking out based on volume. This is suggesting more broad market strength. And we're seeing the red line still above the S&P 500, and I always have to point this out. Yes, they are on different scales, but if you can see over a period of time, when the red line is above or at least matching the bar chart of the S&P, that tends to be more positive. Looking pretty solid here with the advanced decline line studies across all the indexes that we look at. And we're really dropping off with volume. And that is a bit of a concern, a classic negative divergence there. But really, we might have some overhead resistance at this pivot point here. But we're kind of in no man's land now as far as resistance based on this chart. And the condition of the 20-period moving average, looking pretty good. And the lines are moving up and prices above both lines. So the short-term trend is looking better. When we look at the regular 20-period simple and exponential moving averages, also looking really strong. We're getting a little extreme when we do a 20-period exponential moving average on the S&P itself, but we're going up with the 50 and the 200. And then our usual list of short-term indicators here with the Stochh RSI remaining extreme positive. The same thing with the Williams percent R, the CCI 14, not real extreme, but above this level that we follow. And the CCI 20 is also above 100, looking extreme. And now we're looking more extreme in the short and intermediate term with the stochastics. We're just starting to become extreme with the long-term stochastics. And then we're still looking positive here, but not extreme with the force index. We're extreme because we're getting kind of far away from that 20-period moving average. That's what the boom indicator measures here. We're looking positive, but not extreme with the 50, and we're also looking better with the 200. And we're still extreme with the rate of change going back 10 periods, because if you go back, if you counted all of these bars, it would be somewhere down here in the bottom area, and that's why we're seeing such a big move in this particular chart. And we're still not extreme here with the standard deviations chart. We're in the high +2 channel, but we're not into the +3, at least yet. Balance of power starting to get extreme positive. And we're coming down, but we're still extreme with the CMB composite. The condition of the 50-period moving average above both lines are going up. It would be even more positive in the intermediate term if the red line could cross above the blue line. And here's our regular 50-period moving average study. Still looking pretty solid here. It would be even more positive if the blue line would cross above the red line. The blue line is the exponential, and that moves faster. And looking at all of our moving averages, and we're seeing the shorter term moving averages starting to turn back up here, and we're above all of the other moving averages here, so that is positive. And we're still brown with the go, no-go system. You'd think it would switch over to a full like blue or something, but it hasn't. We are going up and looking positive here. We're hitting the blue area, which is the highest high value of this chart, and the midpoint continues to turn and go up. We're still looking positive and possibly getting to the point of being extreme positive with the TTM squeeze. Now, I put this black line on here, and I always want to point this out. There's nothing magical about it. I look at a long-term version of this chart, and I just kind of eyeball it. So we could be getting extreme, but we could still go above this nonetheless. And we're coming down a bit as we're slowing down with the standard deviation. This does not measure direction. This measures speed over the last 10 periods. And we're looking positive and above zero with the ease of movement. And the Erin finally it woke up at the beach or something and finally kicked over from being negative and has now switched over to positive. What this does is the green line, these are buyers, and this is all the way at the top. The red line are sellers, and that's declining. And the difference between the two is the oscillator down below, and it finally picked something up after being sideways for quite a while and has now switched back over to positive. And we're getting extreme. This could also suggest good momentum with the S&P 500 McClellan oscillator. We're above the 60 level, but when we're above zero, the summation index based on price and volume continue to advance, and they're matching each other now. And we're going up with the NYSE McClellan oscillator and also above zero. So the summation index based on price and volume are going up. And we're doing okay here with the Swenlin trading oscillator based on price. It did turn up. We're still extreme positive here based on volume. And we're going up with a momentum here with the PMO. And we're also looking positive when we break it out based on price and volume. Our PMO studies here with the PMOs that are rising, starting to get extreme, going up with the buy signals and slowly going up with the PMOs that are above zero. And we're positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR since the dots are underneath. The slope oscillator starting to get above this green line. Again, I put this green line on here, so there's nothing magical about it. It could still continue to go up. It's just other times when we get above this level, that's when we want to be more aware of this. And the MACD is above zero and advancing and above its moving average. So that is positive. So all of our momentum oscillators, short, the top two charts, intermediate, the middle three charts, and the bottom charts have now turned over positive. The Copic curve, another momentum oscillator, is positive, and the Sean trend meter getting into this initial area of looking extreme. It's really extreme when we get into this kind of dark pukey green area here. And the balance of power continues to go up and not necessarily extreme now. This is a completely different indicator that measures point and figure buy or sell indicators. It's not moving average based, so that's one of the reasons I really like this. And this is also a primary indicator that I use. This is just showing that there's buy signals spread across the S&P 500, and that is positive. Now, when we break it out with the NYSE bullish percent index, this is also going up and positive, and we're starting to get extreme, which again could suggest good momentum. But when we get over the 70 level, that's when we're like, okay, this is starting to concern us a little bit. Maybe it's looking a little too good right now with the NASDAQ 100 bullish percent index. The money flow is above 50 and going up. That's positive. We're starting to get extreme with the ultimate oscillator. On-balance volume is above the moving average, and the moving average is turning up. The RSI 14, which is more intermediate term, we're above 50, and we're going up with the 9 period, and we're not necessarily extreme. We're just below this extreme positive reading. And we look at the stocks in the S&P 500 above their 20-period moving averages. Now, there's two ways to look at this. We're getting extreme, or this is showing really good short-term momentum. And here is the study. Usually we look for the momentum when this breaks above 70, and that is also suggesting good momentum as well. We're going up with the 50-period moving averages, the 100 and the 200. So all of these are looking pretty solid right now. We're waiting to see this drop below the red dashed line. And I don't know whether to take this serious or not. Sometimes it gives us a good signal, sometimes not so good, but we will be paying attention to this. When this crosses down below the red dashed line, the mass index is trying to signal that there should be a reversal. Okay, so we'll see if that ends up working out that way. Pring bottom fisher, even though we went down a while ago and the Pring bottom fisher was going down, now it's starting to generate a buy signal. Now, one thing that was interesting, where was this? There have been a few times when this generated a buy signal without necessarily bottoming, and it was pretty good. When we were coming up in July, it crossed over and gave us a signal without us really going down, and then we saw a nice little upthrust after that. That's not the way this indicator is supposed to be used, but I wanted to show this since we're crossing above the moving average. You could take this as a very loose positive based on what has been happening recently. Support and resistance. We did start a new cycle on August 19th. Sometimes this means something, sometimes it doesn't. We'll just have to see if we're close or near. I know some of the perma bears use these cycle things, and they're like, ooh, we're seeing a convergence of all these crazy different, I say crazy, they don't. They think they're legitimate. But of all these cycles coming together with each other, and yeah, okay, it's interesting to look at those. Except one is a little too cosmic for me. It's based on star movement and planets, and that's a little too crazy, a little too out there for my taste. But that's just how I perceive that. But we could be seeing here a start of a new 50-day cycle, or we may not. You can see other times before, sometimes this did a good job, sometimes it didn't do any job. Okay, the Ichimoku cloud. We're still looking more positive here. We're above the cloud. That's why this is in the support category. But this is turning positive since the blue line is above the red line. And even though it's hard to see, there's a green line in here somewhere, and that is going up. Longer term chart, weekly, breaking out even a little bit more above this R2 level. So longer term, we're looking positive. And isn't it interesting how we came right down to this was the big decline in early August and how we've been able to bounce up since then. Then looking at the fib extensions, we're not quite up to the 61.8 fib extension level for the S&P. That would mean at least matching the previous all-time high. And if we can break above that, things, of course, would be more positive. I don't really rely on this too heavily. I know there are folks that do, but okay, it's something to look at, but I don't make any decisions based on this. Then there's another one later on the cues that I show. But when we look at the trend, the Heiken Ashi, we are positive. We're positive with the Kagi chart, positive with the Renko, positive with the 3-line break. Long term, starting to get above this red line. Again, I put the line on here, so it may not be magical. With the 150, and we're well above the red line that I put on here with the 200-day simple moving average. I just use these as guideposts based on what has happened previously. The rate of change coming down a little bit here, but still above this blue line. And then we're positive across the board with the Keller market model. This is put out by stockcharts.com and also with all the indexes and on all the time frames. And we're still negative with commodities on all time frames and negative with the dollar, where stocks and bonds are positive on all time frames. No changes in the decision point scorecard, so we're positive across the board here. We saw as we were thrusting up and almost made it up to R2, we saw some kind of interesting things happening technically here. And then the NASDAQ fell back, and then the S&P ended up going down below 5,600. We were able to get back above it, but just kind of I guess a couple of negative things here, but some positive things are developing, at least on an alert basis. And then we had all sectors except for the financials were up, with discretionary leading the way. What do you know about that? This is an area that has been disappointing. We want to see more of this to turn more positive on the market. The equal weight is still above the S&P 500 weighted index. Yes, they're on different scales, but you can see when the red line's above the bar chart, we tend to move better. Not always. You can't take this as a blanket statement, but right now they seem to be showing more broad market participation. And we were down a little bit here as the rest of the S&P slightly outperformed the S&P weighted index. Still looking good here. NYSE, broad market measure. New highs minus the new lows, still coming in positive on the daily score. The Dow was up a little bit, 0.14%, but still holding up fairly well, but not back to its all-time high. We're still positive with the diamonds for the Elder's Impulse system. And this is encouraging for the NASDAQ, which tends to use these pivot points pretty heavily. We're still above this pivot point. We've crossed over from negative to positive here with the NASDAQ. So we were up over 0.5%, and this continues to improve. We just want to see, can this pivot point actually hold? If we drop down below that, we'll be watching the 50-day moving average. Also breaking out up over 0.5% with the NASDAQ 100 above its 50-day moving average as well. Positive with the QQQs when looking at the Elder's Impulse system, positive on a momentum basis, crossing above zero. So we're turning more positive here with the NASDAQ 100. And here are the Qs, still above all of these moving averages, and the slower ones are starting to turn back up. Here is the fib extensions for the Qs. We're still below this 38.2 fib extension level here. Small cap, see how we came down and we just bounced right back up to where we were before. So right now it's just a basketball that's being bounced, but still it was an up day over 1%. We're above the 50-day moving average. We're still below this pivot point here. When we look at the Russell 2000 small caps, we're above 50 with the RSI, above the 50-day moving average, starting to turn positive with the momentum. And we're positive with the Elder's Impulse system for the small caps. When we look at the ratio, and sorry about my throat, when we look at a ratio between the small caps and the tech sector, we are going back up, where small caps actually had a little bit better day than the tech sector. Mid caps, we're able to just peek its head a little bit above this pivot point here. This stronger earlier in the year, it's been a real disappointment lately. Could it be starting to get some legs underneath it? And we're positive with the Elder's Impulse system for the mid caps. Then here's a broad market measure, looking pretty good, up over 0.5% with the Wilshire 5000. The total U.S. stock ETF also up over 0.5% and looking pretty solid here. The FANG index up over 0.5% above its 50-day moving average. The Staples to Tech ratio actually went up a little bit here, as Staples had a little bit better day than Tech. Financial sector, one of the strongest areas, was actually down a little bit, but well above its 50-day moving average and coming back to previous all-time highs. This is one thing that we want to keep an eye on. It seems to be working its way off a little bit here. This is the S&P in the top area, and then the home builders ETF in the middle. The correlation, because the S&P was going up as the home builders were just kind of dawdling along, that was producing this correlation to really go down. And we didn't know, is this a positive correlation or a negative correlation? Right now, it looks like a positive correlation because the S&P's been going up, and you see how the home builders ETF had a really solid up day, and that is changing this correlation back more positive. There have been other times when this could be a negative divergence, but we don't really know that at the time. Right now, it just looks like it's a positive convergence is actually what I should say there. The dollar getting down to that 100 level, and we're just about ready to see a death cross here. And this is helping stocks go higher. We're also breaking below this longer term trend line here as we're seeing dollar weakness. And then we look at some of the Magnificent Seven, and I throw another one in there for the Great Eight. Apple was down virtually unchanged, but down slightly, still above its 50-day moving average. Amazon was up 0.69%, still below its 50-day moving average. And we were down slightly with Microsoft and down 0.8% with Google, up 1.6% with Meta, and still kind of getting close here to these all-time highs again. NVIDIA, when everyone's we're getting earnings coming up here pretty soon with NVIDIA. And so people are starting to think it's an automatic cash machine. We'll have to see how this works out, but it was up almost 1%. And then Tesla was up almost 1% above its 50-day moving average. And Netflix was down a little bit here, but still above its 50-day moving average. And then we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows. We're above zero. This is another indicator suggesting the broader market is looking pretty healthy right now. Oil still continues to drop. Whatever's going on in the Middle East, which I'm kind of focused on because I'm supposed to go to Israel here in a couple of weeks, which I don't know if that trip's even going to happen. But if we do see a real escalation there, we're probably going to see an escalation in the price of oil, but it just continues to drop for the time being. And we want to keep an eye on the staples sector here. It's breaking out. This is more defensive. And this is what folks tend to load up on when, at least the smart money does, when they're more figuring that the market's going to be defensive or start declining. And we look at the U.S. stocks compared to world stocks. We have looking pretty strong with the short-term correlation and getting stronger with the longer-term correlation. We're going down with the 10-year yield, and we're going up with the 10-year based on price. This is the other chart I was referring to. When we're up above here and we're coming up out of the rainbow, that means the market is anticipating a soft landing, that we will not go into a recession. When things started to be looking more negative for the economy, that's when we saw this really coming down. But we never actually broke below the rainbow with this chart. This home construction against 3 to 7 year bonds showing some improvement here, starting to break up out of the rainbow. And we look at a broad market measure. The S&P 1500 with short-term bonds coming out of the rainbow. Another broad market measure looking at 3 to 7 year bonds also coming up out of the rainbow. So we're seeing some improvement here. And then we're seeing a little bit of improvement here with the Qs to S&P when we look at our growth to value ratios, showing a little bit better improvement with discretionary to S&P. We want to see this keep going up, and we want to see the moving average turn up. And we're seeing some improvement here with large cap growth versus large cap value. So the large caps are improving, a little bit of improvement here with the mid caps, small caps, even less of an improvement, but still slightly above their moving average. And tending to go up here with the S&P to utilities ratio. We want this to go up. That means the S&P is outperforming utilities. And this is starting to come down. But again, we want to know the context. Right now, we're going with the everything is going to be okay scenario. So this going down has been giving some support to stocks going up when we look at the 2-year yield. And when we look at the Staples to S&P ratio, we actually ticked up here. Staples were a stronger area. And so we want to see this continue to go down to be more positive for the S&P. So what's our outlook for Thursday? The big deal is going to be Friday. Chair Powell is going to be speaking at Jackson Hole, and apparently the Bank of Japan's president will be speaking. Not sure how much of an impact that will have, but based on what happened a few weeks ago, a lot of folks are going to be paying attention to that. And we are getting a lot of retail sales earnings reports that are coming out this week. We are positive, but we're overbought on below average volume. That's just kind of the sum up of things right now. We're going to get the jobless claims and existing home data, and then all the different geopolitical events. And yes, the French Olympics have already ended. And then on Friday, we're going to get new home sales, and also showing new home sales here as well. Seasonality, we're neutral to positive with the Dow, where we're neutral to negative with the S&P and NASDAQ. So really not much of an edge either way. We're still working through the week after options expiration, which tends to be up 65% of the time and down 35% of the time. And as of right now, it's looking like it could lean over towards the positive side unless we see really big down moves on Thursday and or Friday. Thursday is one of the more positive days of the week based on what happened in 2023. We do see some positive seasonality coming in here. We have a couple of days during the S&P here that we're seeing before we see a bit of a drop off next week. And then this is an updated chart fairly recently here. This is what we've been doing in 2024 and then basing it on the election year patterns. These are all election years together. And then this is when there's an open field because everything has changed in the presidential race here. And that's when we tend to see things be more negative going into the election time. And then, yes, August tends to be positive, but on a seasonal basis, September tends to be negative. And we're also seeing that based on this chart. And then if you take August to October together, we tend to see over a 3-month period negative returns, mainly because of what happens in September. But when you look at August during an election year, that's the best performing calculation. And then how 2024 has been matching up to 2023. We'll have to see if they end up staying more in lockstep with each other. So the warning signs, we are watching these defensive areas like staples, utilities, and healthcare. And then growth to value, yeah, they're improving, but they're not really breaking out. We would like to see at least a continuation of this improvement that we've been seeing. And then this home builders study, it's diverging, but it's now adjusting, and we'll have to see it continue to play out from here, but it's actually looking more positive than negative at this point. The S&P going up started to bring the home builders ETF up with it. All right, positive signs, kind of a long list. We're still going down, but getting extreme with our at least our 5-period or 5-day equity put call chart here. But our 3 smart money indicators are all positive, and the advanced decline line is looking good. The S&P and NYSE McClellan oscillators, as well as the summation indexes, are positive, but we're a little extreme with the S&P McClellan oscillator. The Swenlin trading oscillator looking solid, but a little extreme based on volume. Parabolic SAR, all our oscillators are all positive now. The bullish percent indexes for the S&P, NASDAQ, and NASDAQ 100 and the NYSE, the ease of movement, the money flow, the ultimate oscillator, but it's starting to get extreme. The Copic curve, the vortex is positive. The financial sector is positive. And then the momentum for the NASDAQ 100 is positive. So our conclusion, we're positive, but we are overbought or extreme positive or showing good momentum, but on below average volume. In the short term, we are positive but overbought, as well as in the intermediate term, a little bit overbought because of those long-term moving averages, but we continue to be positive in the long term. Thank you. I hope this was helpful, and I hope you have a wonderful day, and I will talk to you in the next video.